Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Services PMI Report. My name is Dan Zeiger. I'm a senior writer and editor for Inside Supply Management, which is Institute for Supply Management's member publication. And we'd like to welcome you to our discussion as we break down the Services PMI data for October. Business activity and new orders levels increased, but so did prices. And prices went above a dubious benchmark, while employment remained in contraction. We'll discuss those details and more today. As the composite PMI reading increased to 52.4%, returning to expansion after an unchanged status, that's meaning a reading of 50% the previous month. So as usual, there's a lot to talk about, and there could be a lot more to talk about with the Supreme Court deliberating tariffs as we speak. We'll touch on that a little bit today, but we'll discuss a lot as we bring in the chair of the ISM Services Business Survey Committee. His name is Steve Miller. Hey, Steve, how you doing?
Good morning. I'm doing great.
Good. What stood out to you about the October data?
Well, it was nice to see a bounce back to August numbers.
Mm-hmm.
Yeah. Am I coming through okay? I'm seeing a little bit of...
I can hear you just fine.
Okay, great.
Yeah.
So the new orders and the business activity indexes being very strong and seeing them get back almost to the same levels as we saw in August as well. The other thing that stood out to me was we had three pretty significant industries bouncing back into expansion territory. Retail trade, which you might expect during getting into the holiday shopping season. Real estate rental and leasing may be starting to see some of the positive impact from the rate reduction or anticipating further rate reductions. And agricultural, forestry, fishing, and hunting, which is dominated by agriculture, which was a bit of a surprise to me, given the talk around soybeans and others. So it was nice to see that pop into expansion from contraction. And accommodation and food services, probably a nice sign for consumer spending, has been strong in the last 2 months. Has led the pack in terms of strength of the PMI reading. Yeah.
Well, you mentioned new orders, and we'll talk about that, and business activity as well. But the new orders index specifically, we talked about that last month. And, I don't want to say it's been volatile because it's obviously stayed in expansion, but it's been a little fidgety. I guess you could say. The last four readings, I'll read them in order: 50.3%, 56%, 50.4%, and then finally up to 56.2% in October. Just what do you think is going on with that index and new orders going back and forth like that?
So two things. One is seasonality. Mm-hmm. We were at 56.7 in October of 24. That was down from a 59, though. So see kind of the strong orders this time of year anyway. But the other piece of it is, I think, just the volatility around tariffs, what to do with tariffs. There was some advance buying. There was some inventory drawdown. We're continuing to see reduction in inventory, which I think is an indicator, but strong new orders, to me, signals that we're starting to see some confidence. Not a ton of confidence, but at least a confidence that there'll be some continued business performance. So that's really positive. Because what you do is, if you're not seeing that, you just sit on the inventory, and we already think inventory is too high. So you would sit on inventory and wait it out until you see demand. But the new orders are certainly a positive sign.
Yeah. Another index that stood out, you cited it in some of the interviews that you did earlier this morning. It's one I think we've mentioned it before. It's an index that seemed to get a little bit more attention on the manufacturing side because, maybe the, manufacturing inputs and products are a little bit more tangible. But the backlog of orders index for services, you had mentioned, highlighted in the report, 2 of the last 3 months, it's hit its lowest reading since 2009. And the figure of 40.8% in October, you had mentioned it kind of continues a 3.5-year downward trend for that index. And it also indicates that companies are keeping up with their orders, despite employment staying in contraction. Just discuss that, that situation.
Sure. The backlog of orders at 40.8 this month and at 40.4 2 months ago is the first time since 2009 we saw two readings below 41 in a 3-month period. 2009 was not a great year. For me, one of the things that it shows is with supplier deliveries right around 50, it's 50.8. It was 50.3 2 months ago, 52.6 last month, but it's ranged pretty much between 50 and 51 for many of the months going back, say, to March. For me, what that's saying is, okay, so we have weak unemployment, supplier deliveries are pretty good, new orders and business activity is pretty strong. At the same time, we're being able to manage down our backlog. So that means we're not capacity constrained. We're not unable to fill orders. And if I really want to go out on a limb, I'd say that's one of the reasons why we're not seeing inflation kick up, is that companies have the capacity to compete with each other to try and win new business.
Mm-hmm. Yeah. We'll talk about inflation and some of the dynamics affecting that. We'll get to the prices index in a moment, but another index that is going to be closely watched, especially during the shutdown and the wait for federal jobs data continues. The employment index increased to 48.2% in October. That's a fifth straight month of contraction. And amongst company surveys, 14.3% reported increasing staff, up from 12.1% in October. We also got the ADP report today. And as I said to Susan Spence about manufacturing, until we get that federal data, I mean, ADP and ISM, those are going to be the authoritative employment numbers for a while, at least. ADP was 42,000 in October, which is what it is. But yeah, just talk about the employment situation in October.
Sure, Dan. About 3 months ago, maybe it was 4 months ago, I took the revised employment numbers and compared them against ISM employment numbers. And what you saw is within 1 to 2 months, there was a very strong correlation. If you just shifted the Bureau of Labor, the BLM numbers, for a November reading off of the September ISM reading, so just a 2-month shift, you would see very close correlation between that over the last since the pandemic. So I won't be surprised in 5 months when we've done 3 months of updates for the numbers that come out this month and next month, that we'll see a very good correlation that shows weak but not quite as weak employment numbers from the BLM. We've seen this these employment numbers and index for the last 6 months be weak. So I would expect for the next 2 months we'd be seeing weak numbers from BLM. The commentary doesn't say, and the number here doesn't say we're seeing dramatic layoffs or furloughs like we saw during the pandemic, where the numbers were in the 30s. We're seeing slightly below 50. We're seeing commentary that says we're not backfilling as quickly. Attrition isn't being filled, like retirements are not being backfilled as quickly. There's delays in hiring, but only in a couple of cases, particularly impacts from USAID funding and some education funding. We're not seeing significant layoff activity. At least it's not coming through in the commentary.
Yeah. Well, sticking to that, the topic of the shutdown, I mean, you indicated in your comments in the report, and there were some panelists citing some issues or maybe even anxieties, regarding the shutdown. I mean, I think of services industries, I think of public administration, obviously, educational services, are among the first industries that I think of that could be impacted. Just give us the situation there.
So I spent a little bit of time looking at the last shutdown, which was up until now the same length. Now we'll see how it matches up if we're able to get things, or if they're able to get things resolved. We saw public administration drop to contraction from expanding month over month. So that came at the same time as we saw a 2.4 percentage point increase in the PMI. Last shutdown, we saw a decline in the PMI at this same point in the shutdown. So, but it was post retail. It was post Christmas. And so my read on this overall, Dan, is that we're seeing some negative impact from public administration and from the shutdown. However, we have a couple of positives. One's a negative positive, the other's a positive positive. The positive is for retail and wholesale trade, and a little bit of transportation. We're seeing positive signs that this could be a good holiday season. Accommodations and food services, we're seeing strength, which indicates we've got some consumer spending still going on. That's positive. Business travel is going on. That's positive. The negative positive is we're also seeing a spike in virus activity in hospitals. So there are colds and flus and maybe some other COVID type things coming through. But some of the commentary from the from hospital and healthcare is we're seeing a seasonal spike that you would expect, cold and flu season. That's why it's called cold and flu season. And then some additional activity around vaccinations. So that's positive from a business standpoint in the healthcare industry, but certainly we don't like seeing more people get sick.
Yeah, let's move on to the prices index. That was something that was going to get a lot of attention today. It was especially because it reached that threshold that I mentioned in the intro. It hit 70%, and it's the first time that it got to that level since October 2022, when it was 70.7%. That index has exceeded 60% for 11 straight months. 16 of 18 industries reported higher prices paid. We saw a little bit of relief from manufacturing in October as that index dipped below 60%, but didn't get that way in services, at least by the numbers. Just discuss that situation.
Sure. We're continuing to see not as many, but we're seeing commentary around flow through of tariff impacts and suppliers talking to our respondents about pricing increases related to tariffs that are now agreed to. The positive sign is we're also seeing their ability in many cases to negotiate some of those impacts away. But what we saw is on things that have a high percentage imported items in the commodities read that's in the report. We continue to see copper products, electrical components, labor, of course, pricing up, but also office supplies, MRO, and valves and chemicals as a broad category. You won't see chemicals in the report because it's too broad of a category, but we saw different chemical items coming in on a one-off basis that were up in price for the first time. So we're definitely seeing those flow through from a pricing standpoint. It's tough to take, the hindsight is 2020 kind of logic. Are we a buildup like we were prior to COVID, or the COVID recovery, where we saw prices get into the 70s, then they got into the 80s and stayed there from an expansionary standpoint? Or are we just there's pricing pressure coming in? And because of my comment a few minutes ago, it appears that there's plenty of capacity in the services industry to provide services, given that employment is down a little bit and backlog is shrinking, with new orders coming in pretty strong 2 out of the last 3 months. So from an inflationary standpoint, we'll wait and see. The 70 reading is first time since October of 2022, when I think inflation was around 6%, something like that. But it was coming down from 80, 80, 82, 85, 80, 79, in the previous 12 months. So I'd say it's not an alarm, but definitely a red flag versus a yellow flag from the last couple of months of hanging around the high 60s.
Yeah. Well, you had mentioned a couple of commodities as it relates to imports, and I had a question on that, so we'll go there before we kind of talk about big picture and what the Supreme Court is doing today. Let's talk about the import index. It was notable. It has decreased 10.9 percentage points in the last 2 months, from 54.6% in August to 43.7% in October. Now, there's a caveat there about 60% of services businesses, don't import, or at least don't track it. But yeah, at least one panelist cited tariffs. I'll read the comment. I got it right here. It's from a respondent in utilities. He or she said tariffs continue to cause disruption in contracts and contracting, driving up pricing on goods, particularly engineered and manufactured equipment. The backlog of existing orders with delays continues to persist for equipment and manufactured equipment. Just talk about what's been going on with the import activity, and are tariffs having that big of an impact?
So on this, my interpretation of the numbers at this point, Dan, is we're kind of on the end of the curve of we need to get product in before permanent tariffs come through on contracts. A lot of people that do annual contracting that are on a calendar year business cycle are coming to the end of the year, need to get new contracts in place, and they were ordering ahead. If you're importing products, you need to get ahead of the peak for retail coming in, which means you got to get in before August. And then you have some things just because of lead time or supplier delays come in later on in the year. What we know is that from the respondents' commentary as well as the numbers is that we're seeing people draw down their inventories, and we're seeing the opinion that inventories are still too high. So the way I'm bundling all of this together is inventories were increased earlier in the year. We're continuing to draw them down. Orders are okay, not through the roof, but they're strong. And we can lay off of the imported products that we brought in so much of, as we still believe that our inventory is a little bit too high.
Yeah. Well, on tariffs, I'd
expect to see after the first of the year. In fact, I'd expect to see in November and December some increased import activity, and then I'd expect to see it again drop off after the first of the year, and then increase later on in the year. Just kind of, okay, let's get our last bit in before the end of the year when the new contracts go in place, and then after the new contracts go in place, a little bit of a wait and see if maybe there's a reversal. Now, does the Supreme Court decide today that the tariffs are going away? I think it's highly unlikely, but I'm in the minority, I think, in that perspective.
Yeah. Well, let's talk about that. I mean, this is the big picture question that I have for you from time to time as we discuss. I mean, there was the agreement between U.S. and China announced last week, that will start having ramifications if it holds. The Supreme Court this morning, possibly still as we speak, is reviewing the legality of the president's use of emergency powers to implement tariffs. I know we've been hearing for months among the supply chain community, we just need to get into a place where we know the scoreboard and the situation and the lay of the land, and we can deal with it. Are we there? I mean, it just seems there are still so many moving parts. It just doesn't seem like the supply chain and the companies are there yet? I mean, yeah, just give me your impressions on that.
I had a old boss who said, Steve, sometimes you just need to sit back and watch. You'll learn more by sitting back and watching in times like these than you will in many other times. And it was a recessionary time period where we were trying to figure out, okay, how do we keep manufacturing going? What's the right demand that's going to be coming through, that type of thing. Fortunately, I don't have a whole lot of responsibility around treating tariffs and the products that we buy that we use to support our company. Okay, so let's say it comes down the other illegal. Okay, so now we've paid tariffs for 6 months. What happens then? How do those get recovered? How do they get billed back? What conversations do we have suppliers whose prices creeped up and they said they were because of tariffs, and now we'll go back to take those out? That's all the time that we're also supposed to be managing supply. So, and last time I checked, other than Sunday, nobody gave us an extra hour of the day to take care of this stuff. So we're really capable people in supply management. And we deal with many more uncertainties and variables than most do, I think, in their daily job. So I don't think it'll be chaotic, but I also think it'll be settled, which will be nice news. Once it's settled, then you know how to plan going forward, which will be a positive. But if it's reversed and settled, there'll be a lot of activity between now and the end of the year for getting things aligned and deciding what the financial impact is for year-end profitability reporting. Boy, it's going to be a very active time if it's found that the president doesn't have the power to do that.
Yeah. And it's a fortuitous time of the year anyway, but it's not like there's anything else going on, with supply chains and ordering and something coming up that's pretty significant in terms of, but exactly. Never a dull moment, as I hear from, supply chain professionals every day. Well, here's another big question, big picture question. And I know you've talked about the 12-month average for the PMI. It's lower than it has been in previous years, as we've documented, but there really haven't been wild swings. I mean, if you put it on a chart, it doesn't look like an EKG. It's relatively steady. The 12-month high and the low readings are within, 2.5 percentage points of the average. And Tim Fiore, when he was chair of the manufacturing, committee, would say this a lot to me. Given the current economic uncertainty, steady is not the worst place in the world to be. Is that kind of the story for the services sector right now?
I would agree with that, Dan. The larger question on employment is really the thing that I think is having a lot of negative pressures. We improve it's our job to improve productivity year over year, do more with less, do better with the same. So with low growth to no growth, we don't need as many people. With AI impacts, if they actually flow through to the bottom line, we don't need as many people. So if we don't see a return to 52, 53, 54, 60, like we've seen in the not too distant past for the services industry, we're going to see declining employment. Sooner or later, or maybe right now, that creates pressure on purchasing of services, which you see slower growth. Lower employment leads to slower growth, which leads to lower employment, which leads to slower growth. That seems to be what has happened over the last year or so in the services industry, and going back 2 more years from a PMI standpoint within the services industry. It looks like the employment pressure is starting to be realized with the lower or slower hiring. Again, not catastrophic. Fairly stable is not a bad thing, but if in order to drive greater employment, we're going to have to see more growth. Now, on the other side of that, some of the immigration changes have probably created a situation where employment is better than it would be for some people in the market than it would be otherwise, which isn't a bad thing. From a if you're a citizen and you're working, if you're on an H-1B and it's going to be much more costly to have you over here, that's going to be a positive impact for U.S. employment if we have the skills to fill the jobs. Otherwise, it's just going to be a negative impact to productivity and production. And when I think of production, I'm thinking of information management, of support services, those kinds of things. If they're starved for talent, the services will be delivered. They just won't be delivered by U.S. companies.
Mm-hmm. Yeah. Well, yeah, it's always a great discussion with you, Steve. And, we're at that point where we got a couple minutes left, and it's where I typically ask you, is there anything that we haven't talked about to this point, or that I haven't asked that you think might be, important to include before we wrap up? Or, if I'm a CEO or executive, what are some of the important takeaways I should have, just before we wrap up?
Yeah, I would say my parting comment for the moment would be, if you're a leader of people in supply management, and we actually get a decision from the Supreme Court that says President Trump did not have the authority to put in the tariffs and those get reversed, grace would be the key word. Don't be a spreadsheet. Don't have a spreadsheet mentality where, I changed the number, it all updates. Okay, we're good. There are a lot of supply management people that will be very, very busy on your team. Give them grace as they try and figure out what the impacts are and how to adjust for them once a decision comes down.
Yeah. Well, yeah, whatever happens, I'm sure there will be a lot to talk about as usual. So, yeah, we'll have a lot on our plate, I'm sure, when we convene in December to discuss the November data. So, Steve, thanks a lot. I appreciate your time today. Thanks.
It's a pleasure.
Yeah. And thank you for joining us today. In a bit, you can go to ISM's website to read the roundup article that details a lot of what Steve and I have discussed here. And if you want to be a part of the ISM manufacturing or services business survey panels that help compile data for the ISM PMI reports, you can go to ismworld.org/join the panel for more information. We'll see you back here next month, as I said, when we break down the data for November. For Steve Miller and some people who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, I'm Dan Zeiger. We'll see you next time.